InvestMentor, an investor education initiative by Kotak Mahindra Mutual Fund in association with Network 18. This InvestMentor series is for anyone and everyone who wants to look at building their personal wealth in a planned and systematic way. Over the coming few weeks, InvestMentor will cover all aspects of investing, how to begin, the basic concepts that you must know, be it the debt or the equity market, the choice of products, and even the choice of a financial advisor. The aim is to enlighten our viewers, helping them meet their financial goals. To discuss this, I have with me Lata, who's, of course, my co-host on the show. And in a bit, we'll be in conversation with Nilesh Shah of Kotak Mutual Fund, Lata.
Oh, absolutely. If anyone wants to learn the basics of investment, I think Nilesh Shah is the best person. I have myself learnt the ropes from him. We go back a long way. Nilesh, thank you very much indeed for joining us. Well, first up, actually, we are starting this InvestMentor series at a very interesting time. We've just put behind a year when the market saw rock bottom with Nifty at 7,500 and then, doubling to 15,000 in record time. What's your sense? Do you think you need better skills now and therefore these skills are best left to an expert and shouldn't be done on one's own?
So there is never a better time to learn. If you stop learning, you stop growing. In the financial matter, Lata, we have witnessed that despite lots of attempts over last 2.5, 3 decades, the financial inclusion, the financial education still continues to remain poor, especially in middle to bottom end of the pyramid. We did a study where we found that more than 100,000 crore was lost by probably semi-urban and rural people in various collective investment schemes. And which is where, whether index is at 7,500 or 15,000, it is important to spread right financial knowledge.
Nilesh, what we have witnessed in 2020, probably because people are working from home, is that there are ever more people who want to do it on their own. What is your advice to them?
So if you have dedication, time, knowledge, then certainly doing on your own is good for you. But if you don't have time, knowledge, or dedication, then it is far better to leave that job to the professional. What has happened, Lata, in the past, that people chase momentum. They think that making money is very easy based on a bull market, and then they end up coming into bear market. People end up using leverage via futures and options, and then they end up suffering heavily when price goes against them. To this set of investors, professionals will be far more better.
Nilesh, great to talk to you and start off this series. My question is simple. We're also having this conversation at an interesting time when the market has entered what seems to be a brand new, breathless bull run. Now, I don't know if you agree with that view or not, but it will confuse people even more, because if you hold on to traditional ideas of valuation, price to earnings, maybe you'll miss the upside, and then you also wonder whether this is excessive. So what would you tell retail investors at this point?
My request to retail investors is very simple. Do regular investment. There is a saying which says that small drops of water make an ocean. In financial world, it is most important. The second thing is to be a long-term investor. There's a saying that you can't grow a mango without 12 years of wait. Same thing is true for investment world. In some sense, investment world is like birbal ki khichdi. It takes time to cook. And the third thing is disciplined asset allocation. Majority of return comes when you allocate your wealth appropriately across asset class, rather than trying to invest in the best performing asset class. These three aspects of regular investment, disciplined asset allocation, and long-term investment is critical for retail investors.
Well, actually, Nilesh, why don't we start there? What are the first lessons in asset allocation that a youngster should know? Before we know it, when we get our first salary, we have already put some money in EPF and stuff like that, which are basically debt instruments. Or maybe, your parent tells you to put money in PPF. What should be the first lesson in asset allocation that you would want to give a fresh investor?
You need to divide your portfolio across real estate, commodities, currencies, equities, and fixed income. If you go towards fixed income, you will generate probably negative real return, lower return than inflation, and not grow your wealth as much as you should. If you go towards high-risk assets like equity and real estate, you may end up generating much higher return, but if you succumb to the volatility in between, you end up losing the upside and suffer the downside. So the key is to create a balanced portfolio across various asset classes, just like you create balanced diet for your physical health.
I remember one of the first lessons you told me is that your investment in equity should be 100 minus your age. Is that still the way to go through? Can you explain to people who are listening?
So definitely, Lata, 100 minus your age gives allocation towards risk asset, which includes equity. Obviously, persons are not alike. Within the same age bracket, one could be conservative, average, or aggressive. One's objective could be different. But this thumb rule towards risk allocation does signify that as you become older, your risk appetite might be coming down, and you need to make adjustments according to that. It's as simple as when you're on a plain highway, you can run at a faster speed. But when you enter a ghat area, you need to slow down on the turns.
Okay. And Nilesh, before we delve a little deeper into both of the markets, equity and the rules there and debt and the basic rules there, I want to ask you a more basic question. Today there's so much noise and there's so much advice and there's so many apps. We're in the era of robo-advisory, then there are distributors who are also advisors, there are independent advisors. So for someone who's just beginning their journey, what should be the best approach and what are the questions this individual should ask themselves while selecting on an advisory model?
So essentially, when you go to a chemist shop, you go with a prescription to buy. You just don't go and explain your problem to chemist. Same way while buying mutual funds or other investment product, it is important to go with the prescription. And that prescription will be from your mutual fund distributor or financial advisor. Now, if you're moving to a new town, how do you select a doctor? You go by references, you go by his clinic's appearances, you go by your own experience. The same thing is applicable with mutual fund distributor. You take references from someone who knew, most probably they will be able to lead you to someone good. Second, you go by their approach and their professionalism. Are they interested in transactional relationship or are they interested in a long-term relationship? And finally, start small and build your experience. If you believe that person is servicing well, then continue with him. So my feeling is that it's important to go into financial product arena with a prescription which suits your risk profile and which meets your investment objective.
Well, Nilesh, while we are on this topic, let me put forth a problem which perhaps many other investors like me will feel. While you get confused while choosing companies, and that's why you get scared to do it on your own, you go to a fund manager. Even when you look at the number of mutual funds, you get confused. I mean, there are literally hundreds of equity and fixed income products. So what would you advise an investor? How do they choose between equity funds? Is it good to trust the mutual fund manager himself and therefore go to a balanced or a balanced advantage fund, something that combines equity and debt? Or is it better to go to a professional advisor and tell him your risk appetite and be advised?
So if you really want to do it on your own, then probably asset allocator fund and balance advantage kind of fund will be appropriate, where you leave it to fund managers' discretion about investing in equity and debt, or maybe some other asset class also. But this is not custom solution. This is like ready-made garment. There is predefined size available. It fits in great. If you don't fit in, or if your size changes, you will be in trouble. When you go to mutual fund distributor, you are going to a person who will do tailor-made solution. If your paunch is little higher, he will try to hide it by altering the design. So you figure out whether you want customized solution or you want generic solution. For generic solution, balance advantage fund, asset allocator fund will be appropriate. But mind you, as your risk profile changes, as your investment objective changes, the fund will not be able to alter itself. Whereas if you go to a mutual fund distributor or financial advisor, you will get customized solutions.
Okay, all right, got that. That's important advice to keep in mind. We'll take a quick break. Nilesh stays on with us, and then we delve a little deeper. The basic house rules to keep in mind while you're starting your investment journey. We're back in a moment.
Kotak Mutual Fund presents Invest Mentor in association with